coming off the back of a week that has been heavily geared towards central banks. This week sees inflation taking center stage with the core PCE price index coming out of the US at the back end of the week, also CPI coming from Australia. And just to continue that central bank theme, we've got the SNB interest rate decision out of Switzerland as well. Now, let's take you through the top ticket items to watch out for over the course of the week. This is according to Trading Economics. And in actual fact, I've snuck in the SNB rate decision on Thursday. But on Tuesday, we've got PMI numbers coming out of the likes of Europe, the US, the UK. Then we've got the IFO business climate reading on Wednesday from Germany. That German theme continues with the GfK consumer confidence on Thursday. Then we've got the SNB interest rate decision from Switzerland. And then we have a keen focus on the US durable goods, core durable goods, existing home sales, GDP. That's a final reading for Q2. And then on Friday, the core PCE price index figure alongside personal income and personal spending numbers as well. And that's where we're going to kick things off. And you can see here that we have got a relatively busy week, and it's really focused on two main days. That's Tuesday, where we have the PMI numbers coming out, and then on Friday, I would say, where we also see the likes of the core PC alongside personal income, personal spending. Well, Thursday is going to be important as well. But ultimately, it gives us a good view on exactly where the economy is right now. But crucially, it comes at a time where we've just seen the Federal Reserve interest rate decision. They opted to essentially lay out a pathway where we were going to see interest rates throughout the back end of the year. So a rate cut of 25 basis points this time around, then another 2 for the remaining 2 meetings. And so markets are now pricing essentially a guaranteed rate cut for the coming 2 meetings. But then they essentially said that for the year ahead in 2026, it was just going to be a single rate cut. And so really markets didn't know exactly how to take it. Optimism over the near-term rate cuts, but some caution about exactly how much to expect from them in the coming year. It's notable, though, that central banks, within their nature, essentially are relatively cautious. They've already said they're on a data-dependent approach, and therefore to say exactly how many rate cuts they're going to enact in a certain year really is disingenuous, because they don't necessarily know exactly what the position is, what the state of play is in terms of the economic data at the time of having to speculate. So where we land exactly, where we're standing in a few months' time when it comes to the rate decisions at the beginning of 2026 and as we move through, that remains to be seen. If the jobs market continues to weaken, it's very likely they will continue to cut despite that. In terms of the expectations over exactly what's going to happen over the near term, like I said, markets now pricing pretty much a guarantee that we're going to see rate cuts over the coming meetings. But that also comes down to the dual mandate, right? Do we see continued weakness in the jobs market? Do we see continued sort of depression in terms of inflation levels, and that we not necessarily see it picking up in a meaningful manner? And that's why the fact that we've got this core PCE price index inflation reading coming out, that's why it's so important. As we can see back here, the core PC price index number on the year-on-year basis is 2.9, expected to rise up to 3%. And then the headline PC year-on-year figure, 2.6, expected to rise up to 2.8. Notably, though, both the core PC month-on-month and the headline PC month-on-month expected to come in at 0.3. So it's not that we're seeing a massive rise in terms of inflation pressures over the near term that's driving it up, but we've also got base effects coming into play. Nonetheless, what's notable here is that we have seen a steady ascent in terms of monthly inflation. So it does point towards inflation pressures building. Notably, within the latest CPI report, you can see the orange or yellow, call it what you want, bars. That represents core PC. So that has been gaining traction. There's an expectation it comes in at 0.3. Does it come in higher than last time around? That would point towards a building of inflation. But of course, this data that we're seeing right now is a known entity. So we'd need to see inflation coming in to an extent that is over and above what markets are expecting, if that's to really sort of move the dial in terms of expectations within the markets. This is what I was highlighting previously when it came down to the outlook for rates of 2025 and 2026. You can see that we did see adjustment in terms of the outlook for 2025, but the downward movement for 2026 was marginal when you're looking at the median outlook, and distributed when you're looking at the entirety. So there's a lot of indecision within the Fed, and that really highlights the fact that we're going to have to focus on the data as we move forward. And that's why the likes of the core PC price index metric will be very important within that. So let's jump onto the chart here for gold. First and foremost, I think gold's a really interesting market to be following when it comes to the reflection of market sentiment around rate cuts and the like. Essentially, data in my mind, this is how it's playing out. Data that benefits the idea of rate cuts should be beneficial for gold. But if we see data that pushes back against the idea that we're going to see near-term rate cuts, you can see short-term pullbacks, but they generally have been relatively fleeting. The caveat to that is we haven't necessarily seen a major uptick in terms of inflation. If we were to see a major surge in inflationary pressures, likely would depress gold prices. But as we can see here, it's been doing very well thus far. And this sort of triangle breakout that we were talking about at the time, we've followed through in an incredible fashion. So this time around, we're in a sort of pullback phase, of course, coming off the back of that rate decision from the Fed. This is it on an hourly time frame. We're sort of seeing this lower highs, lower lows. For me, it's a retracement of this rally up from 36.12. And therefore, the 76.4 fib, which is, it's kind of hidden here, 36. There you go, 36.35. That's where I'm hoping this market turns around towards the upside, essentially. So we've started to build a base here, respected it 3 times. Now we're starting to regain ground. Certainly more confidence comes with a breakup through this level, 36.73, and more pessimism or caution comes if we were to break this low here, which is 36.12. Until that happens, for me, this pullback is likely to be fleeting in nature. And certainly if inflation comes in under control once again, that feeds into that narrative and points towards further upside coming into play for gold. Next up, let's look at the outlook for Australia. It's not necessarily a super busy week when it comes to data, but of course we've got the PMI numbers coming out on Monday. An expectation we see weakening manufacturing, weakness certainly in the services side, expectations of a massive decline there in terms of that services number, and that's driving expectations of a sharp decline when it comes to the composite reading as well. Quite whether that is going to come to fruition or not remains to be seen. I'm just quickly double checking that those numbers are correct. Let's see what happens sometimes. What can happen sometimes is that you see really significant sort of predictions when it comes to the economic calendar, but that's often when you're taking the data quite early, and I can't seem to find it. That's when you're taking the data early, and then a lot of the time what happens is, oh, here we go. Yeah, 51, it's still there, right? A lot of the time that will come owing to the fact that they're just some of the early estimates that have come in, and you haven't actually seen all of them. And then if you check it a day later, all of a sudden the market forecasts are very different. So that could be one that grabs the market's attention. Notably, though, we've got an expectation of a higher reading when it comes to monthly CPI. That already is elevated at 2.8 and expected to rise further from there. So you can see here that we have started to turn significantly higher in terms of inflation. Last time around, in particular, an expectation that we're going to build on that. And so when we're looking in terms of the outlook, in terms of the RBA, you know, does that stifle their ability to cut rates? Potentially. And you can see here that where we're looking for rate cuts, you're saying not this time around, but potentially in November. Then beyond that, when are we going to see the next rate cut? Marginally in the sort of second quarter, maybe, of next year, but not a lot of confidence in terms of easing when it comes to the RBA at the moment. And interestingly, I wanted to show you the chart of Australian dollar against New Zealand dollar. And this has just come off the back of a release from the New Zealand, where we saw a sharp decline in terms of GDP. You can see here Q2 GDP minus 0.9. That builds on some of the weakness that we saw last year as well. So certainly that essentially builds a narrative around the RBNZ needing to do more and the RBA potentially having to hold off. The caveat here is if we see that collapse in terms of the PMI, that could perhaps start to tell a bit of a different story. But that does really sort of point towards a potential narrative of strength of the Australian dollar against the New Zealand dollar. And if we're looking here in terms of the chart itself, that's exactly what has been playing out thus far as the weekly time frame. I'll show it on the monthly. So that's the monthly. So as you can see, if you sort of get rid of the trend before that, we're not in a massively trending market, quite frankly. We're in a market that you could say is bottoming out, you could say is ranging, but certainly we've broken towards the upside, so we don't necessarily have much resistance over the near term. In terms of price action, you can see here that we're sort of, I mean, I'll draw a trend line, but I don't expect us to get back to it. You could say this is a trend line as well. So essentially, we're sort of trending, and we're trending up in a faster manner than even we were previously, right? So that points towards further upside coming into play. Now, we saw this sharp rise off the back of that weak GDP figure from the New Zealand dollar. Now we're starting to pull back a little bit. In my mind, I think this is going to be like a flag formation or a short-term retracement phase. So essentially, my sort of line in the sand is going to be here, right? 1115. As long as we remain above that level, then near-term pullbacks are likely an opportunity for the bulls rather than indicative of a top for this market, unless we break the 1115 level, in which case it starts looking like we could start to roll over a little bit. But certainly it's going to be an interesting week in terms of the data, and I do think there's a good chance that we see further upside coming into play, particularly if that inflation gauge starts to gain ground once again. And finally, let's jump on to the outlook in terms of Switzerland. Now, we've got an interest rate decision and we're not expecting anything, right? So we're expecting them to keep rates steady. But it gives me the opportunity to highlight the fact that the Swiss franc has been one of the strongest currencies out there. And this is something that I've been talking about, a while back, and saying, these central banks that have already finished with their easing process, they could actually end up seeing their currencies appreciate once the other central banks really start to gather momentum in their easing process. The SNB already cut rates heavily. You can see here 0% on their headline interest rate. And therefore, are we going to move into negative territory? Well, maybe, but more likely we've pretty much done here. And then you start to compare it against the likes of the Federal Reserve, where they're getting going, and also concerns around the strength of the dollar anyway. And that points towards a possibility of further downside in terms of the US dollar against the Swiss franc. This is the weekly time frame, so ultimately our job in part is to try and find, oh, sorry, I'm not showing you the chart. I'll tell you what, there you go. So there's the outlook in terms of market expectations. Basically, no change expected here when it comes to the Swiss franc. And as you can see here, this is where things lie in terms of the different central banks and where they are. The green line at the bottom is the SNB. So they're likely done, and many central banks are not done. And that gives us the potential for relative valuations coming into play, or relative rates coming into play as a driver of FX movements. So this is the trend in terms of the US dollar against the Swiss franc, very clearly a bearish one. The daily time frame tells a very similar story. You can see here, if I was to sort of grab this and push that across there, then you've got a sort of rough trend line resistance coming into play here. Let's just try and grab as many tops as we can. There we go. So we've got this descending trend line. We're actually in a phase at the moment where we're starting to regain ground. This does have a striking similarity to the descending trend line evident within dollar index. It comes off the back of an FOMC meeting where we, of course, have seen them sort of ease back on expectations for rate cuts for next year, but sort of reiterate the likeliness of rate cuts this year. Well, that has provided some strength for the time being. I don't necessarily know that it's going to last, and ultimately we've got sort of technical validators to prove whether it is or isn't, and that comes in the form of a breakthrough 0.8, essentially 0.8008. that price swing high alongside the descending trend line. If we break through that resistance zone, then yeah, maybe it looks like we're set for a phase of more upside coming into play for the dollar Swissy. Until that happens, near term, I'll be looking very closely at 796. That's your 76.4 fib retracement level as a potential area where we start to lose momentum and lose traction on this latest recovery. So keep a close eye out for this, because the trend very clearly is a bearish one, right? So are we set for a wider retracement phase, or are we just pulling back into trendline resistance to roll over once again? That's the key question worth asking on this occasion, in a week that we do see the SNB taking the mantle after a busy week, to say the least, where we saw the FOMC, the Bank of England, and the Bank of Canada, all with their latest rate decisions. I hope this has been useful. Make sure to like, subscribe, and follow for more content like this. My name is Joshua Mahony, Chief Market Analyst at Scope Markets. Have a great day and good luck trading. Thanks a lot.